the formats of financial statements. That's what I want us to study. I want us to study the formats of financial statements of various businesses. One of them is sole proprietorship. The other one is partnership. The other one is company accounts. And I want us to compare them. And therefore, we get the format for a sole proprietorship. We get the format of a sole proprietorship financial statements. We say that a sole proprietorship is a one-man business. We say that a sole proprietorship is a business that is owned by one person, and therefore the owner's capital is by one person. And therefore, we start with the income statement. If we say the firm is called XYZ, and then that's the name of the firm, and then we say income statement for the year ended 31st of December 2025. How do you go about it? We always say you start with the sales. We start with the sales, and then we say less return inwards. We say less return inwards. What are we saying here? When we sell goods to our customers, some of the customers, we have recorded that we have made a sale. But some of the customers will return goods to us for various reasons. One of it could be we delivered more than they wanted, or our goods did not meet the specifications, and therefore they return the goods to us. So we need to reduce our sales with the value of sale which has been returned. And once we subtract return inwards, we get net sales. And then we say less cost of goods sold. And these are the sales we made. But how much do you buy the goods at? So we start with the opening stock. We say opening stock. Yes, the stock we had at the beginning of the year is called opening stock. What did we sell in the course of the year? At the beginning of the year, we never just sold what we bought. We had stocks which were not sold at the close of last year. They are called opening stock. And then we add the stocks we purchased. So we add purchases. But if we purchase the stocks far away, the transport cost of those stocks to the shop is called carriage inwards, and it is part of the cost of inventory. So we say we add carriage inwards. The cost of transporting goods into the farm is called carriage inwards. But just like in sales, maybe we received some goods, but we did not want them. Either because they were not meeting our specifications, they were wrong quantity. They sold to us more, or even they changed the price from what we had agreed. So we are returning the goods. So because we have recorded them as purchases, to get the correct purchases, we must deduct what we returned. So we say less return outwards. So we are subtracting return outwards. We get cost of goods available for sale. Available for sale. The goods which we had, which we could sell. That's the value of the goods which we had, which could sell. We started with what we had, with the inventory which had been bought last year. That's what we started by selling. So we start with the opening stock, then we add the purchases. But as we were purchasing, we transported the goods, we add carriage inwards. But some of the things we purchased, we returned. So all we had recorded as a purchase, because we returned, we subtract carriage return outwards. Whatever we return, we call it return outwards. Whatever we return suppliers is called return outwards. When we get cost of goods available for sale, we say less closing stock. We did not sell everything. We did not sell everything. We subtract closing stock. We get the cost of goods sold. We get the cost of the goods we sold. We get the cost of goods sold. We get the cost of goods sold. Once you get the cost of goods sold, you subtract it from the net sales. Subtract from net sales, we get gross profit. We get gross profit. We get gross profit. It is a profit before deducting operational expenses. Gross profit is the profit we've made. It is the sales we made minus the cost of the goods, how much we incur to get the goods and sell the goods. Then we get the gross profit. That's a profit that we get when we subtract the sales. From the sales, we subtract the cost of goods sold. Then we say we add other incomes. We add other incomes. We add other incomes. We add other incomes, and we say there are very many incomes, like gain on disposal. Gain on disposal of non-current assets. Gain on disposal of non-current assets. Things like interest income, things like dividend income. Maybe we bought company shares in a company and they are giving us dividend, or we had bought debentures in a company and they are giving us interest. So we add interest income, dividend income, and then decrease in provision for doubtful debts. 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 And then we can also have such things as other incomes like discounts received. Discounts received. Discounts received. So we get aggregate income. We get aggregate income. We get aggregate income. And from the aggregate income, we say less expenses. We say less expenses. We say less expenses. And one of them is carriage outwards. Carriage outwards. Carriage outwards. What are carriage outwards? What are carriage outwards? When we are transporting inventory from the shop where we are selling the inventory to the customer, it is called carriage outwards, and it is an expense. It is an expense. We therefore need to know that the carriage inwards is part of the inventory, but carriage outwards is an expense. Carriage outwards is an expense. We could also talk about depreciation expense, and we could say the motor vehicle, furniture and fittings, buildings, plant and machinery. So we get their depreciation there for the year, the annual depreciation. We could be having salaries and wages. We could also be having stationary expenses. We could be having rent. We could be having the interest expense. Maybe we had a loan and we are paying interest expense. And we could be having electricity, water, rent rates. So we get the total expenses there. We get total expenses there. And then once we get the profit, once we get a gross profit, once we get a gross aggregate income, you subtract total expenses, we get profit for the year. We get profit for the year. You get profit for the year. And that is the profit, how to prepare the income statement of a sole proprietorship. That is the income statement of a sole proprietorship. That is the income statement of a sole proprietorship. Now, what you need to realize is that the income statement of a sole proprietorship is prepared exactly the same way with the income statement of a partnership, but there are some things called, there is an additional item called the appropriation account. There is an additional part of the income statement when it comes to the partnership called the appropriation account. What is the appropriation account? The appropriation account is the part of the income statement that shows how the profit that we make will be distributed among the partners based on the partnership deed provisions, based on the rules and the regulations articulated or recorded in the partnership deed. What did you say the partnership deed is? The partnership deed is a document that is written by the partners to record the terms and conditions of the partnership. So, for a partnership, you will do it the same way. You will do everything the same way. So you come here and we will call it XYZ partnership. It is now a partnership. It is now a partnership. We will call it, the first one was a sole proprietorship. This one now is a partnership. We call it XYZ partnership. Now, we prepare the same way, but when we come here, something becomes different. Something becomes different. We know that we talk about drawings by the partners. If there is interest on drawings, if there is interest on drawings by the partners, if there is interest on drawings by the partners, maybe even before we go there, if there is any partner, these are it. If there is any partner who has given loan to the firm, if there is any partner who has given a loan to the partner, so we call it becomes the interest partner is interest. Partner is interest. So we get total expenses. And therefore we get profit for the year. Now, if there was a partner who was given interest, a loan to the firm, if the partner was given a loan to the firm, the interest on that loan is an expense. So we debit the income statement. Partner is interest. We debit the income statement as we credit the partner's current account. We debit the income statement to record an expense, and we credit the partner's current account with the interest income. Then we get auto expenses and profit for the year. Drawings. Drawings is where the owners take money from the farm for personal use. Where the owners take money from the farm for personal use, it is called drawings. And we say that if the partnership deed provides for interest on drawings, the farm will be earning that interest. And therefore, it is an income to the farm. And a payment. It is an expense to the partners. And therefore, we add interest on drawings. They could be having for A, B, C. The amount of interest on drawings for all of them, you capture it there. You get the profit to appropriate. So you get profit for appropriation. It is a profit to distribute. Now, when we get there, if the partnership's deed has a provision for interest on capital, we come here and we say less interest on capital. less interest on capital. Less interest on capital. And we say A, B, C. We get their interest there. We get their interest there. We get it there. The total, we get it there. Please mark, we are adding them inside. We are bringing the total. And the profit for appropriation, we deduct the interest on capital. We get the profit after deducting. We get the profit after deducting interest on capital. We get the profit after deducting interest on capital. We may be having salaries for maybe one of them. So we say less salaries. Less salaries of the partners. Less salaries of the partners. Less salaries of the partners. And maybe we have two partners who are big pay salaries, A and B. A and B. Again, you add them from in the inside. You add them from the inside. You bring the total here, and then you subtract from the profit we had. You subtract the salaries, and you are left the profit to share. You are left with the profit to share. You are left with the profit to share. And once you are left with the profit to share, I want to show you how you continue dealing with the profit to share. Now, the partnership deed should be giving us something we call profit and loss sharing ratios. Profit and loss sharing ratios. So you continue here and you say profit share. So you say profit share. We say profit share. Profit share. But we are sharing profits based on the profit and loss sharing ratios. If you are told that they are sharing profits at the rate of 2:1, it means A, B, C, A, B, C. A is getting 2, this one is 2, and this one is getting 1. So all of them, if you add 2 plus 2 plus 1 is 5. So 2 out of 5, 1 out of 5, 2 out of 5, and 2 out of 5 of the remaining profit. Of the remaining profit. So you multiply by X, the remaining profit, multiply by X, the remaining profit, multiply by X, by the remaining profit, you get the profit share. You get the profit share, you get the profit share, then you add it, and the profit share, the profit here, which has been shared, must be equal to the profit that is available for sharing, and then we get the balance is 0. The profit we had minus what we have shared, we get 0. We get 0. And never forget this. This is the order of preparing of current account. This is the order of preparing of current account. Some students go to preparing the current account before preparing the appropriation account. It is from the appropriation account that you prepare the current account. It is from the appropriation account you prepare the current account. So this is the way now to prepare the partnership, the income statement of a partnership. This is the way to prepare the income statement of a partnership. Few changes from sole proprietorship to partnership. Few changes. Number one, interest on partner's loan is an expense. So you debit the income statement to record an expense, and you credit the partner's account because the partner is earning the interest income. If the partner wants to get the interest, he will have to draw it through drawings. Now, once you get the adjusted profit with drawings, after you have gotten the profit for the year, you add interest on drawings. You add interest on drawings, which is an earning to the firm. It is an earning to the firm. So because it's an earning, you add to the profit to get the final profit. Now from the final profit, you subtract partners' interest on drawing, interest on capital by the partners. You subtract profit, interest on capital. You subtract salaries. And then you do profit share. The remaining profits you share based on the profit and loss sharing ratios. That's the way to prepare the income statement of a partnership. That's the way to prepare the income statement of a partnership. Similarly again, when it comes to preparing company accounts, again, we prepare the income statement the same way. With the process is the same. The process is the same. The process is the same. So, it's the format of the income statement of XYZ company. XYZ company of XYZ company. Or XYZ, or you can even call it limited. XYZ limited. So we start the cost of goods sold, we compute them the same way. We go to the gross profit, we add other incomes, we rest all the other expenses. But when we come to the expenses, we add some more expenses. Never forget this. Never forget this. Never forget this. That when the owners in partnership or sole proprietorship withdraw money from the farm, it is called drawings. It is called the payment by the owners or in partnership or sole proprietorship. It is called drawings. It is called drawings. It's called drawings. But when it comes to a company, the directors are the employees of the owners. They are the employees of the owners, and therefore their salaries are expenses like any other. Their salaries are expenses like any other. So we come here and we say directors' fees, directors' fees, directors' fees, directors' fees, directors' fees, and salaries, directors' fees and salaries. They are expenses like any other. They are expenses like any other. Now, a company is required by law to be audited. A company is required by the company's account to be audited annually. And therefore, you may find that we are talking about audit fees. You're talking about audit fees. You're talking about audit fees. In a company, we can get two types of loans. We can have a loan from the bank, whereby we are paying interest expense, whereby we are actually paying loan interest expense, but we could also be having something called debentures. Could be having debentures. What are debentures? Debentures is where the company is allowed to mobilize the public to give it loans in documents which are equivalent to the shares, but these ones are called debenture certificates. Debenture certificates. So we talk about debenture interest, debenture interest expense, debenture interest expense, debenture interest expense, debenture interest expense. Now, something very important. You must always check debenture interest expense. Anytime you find there is a debenture, you must get the interest rate at the beginning of the description of the name of the debenture, and you multiply by the amount to get the detailed interest expense for the year. To get the interest expense for the year. Then find out in the trial balance, have we paid? Have we paid? If it is not in the trial balance, it means we have not paid for the interest expense. It means we have not paid for the interest expense, and therefore you show it as an expense in the income statement, the way I'm showing it, but you're also showing it as a current liability in the balance sheet. You're also showing it as a current liability in the balance sheet. You might also realize we have paid 50%. And therefore, 50% is, if 50% is paid, it means 50% will be shown as a current liability in the balance sheet. Now, once you get that, and another expense you could find here is something called amortization expenses. Amortization expenses. What is amortization expenses? Is the loss in value of intangible non-current assets. Is the loss in value of intangible non-current assets. And therefore, we get total expenses there. Once you get total expenses, you subtract the aggregate income, you get profit before tax. Profit before tax. Please mark this. In some proprietorship and partnership, we talk about profit for the year. Here we are saying profit before tax. In company accounts, the company in law, it is a person. And therefore, because it is a person in law, it pays tax. And therefore, tax is an expense. So we say less income tax expense. Less income tax expense. We talk about profit after tax. after tax. We talk about profit after tax. Now, once you get a profit after tax, the question may be telling you that we transfer to general reserve this amount. Please listen to this. You're told we transfer to general reserve this amount. If you are told that, you must check from the trial balance whether we have some general reserve at the beginning. So if there is something, you say, you create a general reserve account, you say balance brought down, then you add the transfer to general reserve. So here we say less transfer to general reserve. Less transfer to general reserve. Now we are removing from the profit and we are transferring to general reserve. So the general reserve you show in the balance sheet. It is what is in the trial balance plus the transfer plus what you have transferred to general reserve. Now listen to this. Now the figure you get is the figure from where you're supposed to pay dividends. In company accounts, instead of giving to the drawings to the owners, we pay dividends. Instead of drawings to the owners in companies, we pay dividends. We pay dividends. You must never forget that. We pay dividends. How do we pay dividends? You are given a rate for the preference shares. The preference share dividend is always given when you are at the trial balance, when the preference shares are being described. So if it is 10%, you say 10% times preference share capital. Now then the board of directors declare dividends at the end of the year. So the directors will give you the rate for ordinary shares. The board of directors declare the ordinary shares dividend at the end of the year. The preference share dividend is always given, but the ordinary share dividend is given by the directors at the end of the year. So you get the rate given, and then you go to ordinary share capital, and you apply that rate to get the dividend for the year. So we say less dividend, less dividend, less dividend. Now, dividends could be two types. Dividends could be two types. We could be having interim dividends, which is paid 6 months in the course of the year, after 6 months in the course of the year, and then we declare the final dividend at the end of the year. So we start with interim dividend. We start with interim dividend, interim dividends. We start with interim dividends, and we could say ordinary share capital dividends, and then preference share capital, preference share capital, preference share capital, preference share capital dividend. Now, from there, you add the final dividend. You add the final dividend, you add the final dividend, you add the final dividend, and you say final dividend, final dividend, final dividend, preference dividends, and ordinary dividends. Ordinary dividends. Now you add all the dividend together, you add the interim and the final dividend, you get total dividend there, and the profit you had, you subtract total dividend, you get retained earnings. You get retained earnings, you get retained earnings, you get retained earnings, you get retained earnings for the year. You get retained earnings for the year. You get retained earnings for the year. Something very, 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 very important. You may end up realizing that after deducting from general reserve, the profit here is not enough to pay the dividend as computed. What do? We add retained earnings at the beginning of the year to the profit for the year to get enough profit to pay dividend. To get enough profit to pay dividend. I want to repeat again. If the profit after transfer to the general reserve is not enough to pay the dividend you're supposed to pay, you get the retained earnings at the beginning of the year, you add to the profit for the year, you pay dividend. You pay dividend. You pay dividends. Now, once you pay dividends, whatever is left is retained in the firm. It's called retained earnings for the firm, and you add the retained earnings at the beginning of the year. So you say add retained earnings brought down. Add retained earnings brought down. You get retained earnings carried down. You get retained earnings carried down. Now, retained earnings carried down is the retained earnings that will be shown in the balance sheet. as the retained earnings. Never forget this also, that more often than not, you may find a question that is talking about general reserve. You know, general reserve is where we transfer this, and revenue reserve. Instead of talking about retained earnings, they are talking about revenue reserves. Never forget that the revenue reserves in the trial balance is the same as retained earnings. Is the same as revenue reserve is the same as retained earnings, and it can be used to pay dividend. It can be used to pay dividend. So our retained earnings will be shown within the shareholders' funds. We will be saying ordinary share capital, preference share capital, share premium, general reserve, retained earnings, and we say retained earnings are also called revenue reserve. That is the way to prepare the format for the 3 different forms of businesses: sole proprietorship, partnership, and company account. Once again, subscribe to our channel and hit the notification bell so that every time we load a new video, you are being notified. Thank you very much. Cheers. Wish you the best.